Here's a shocking reality check. Home prices are up 60% nationwide since 2019 and still rising at a rate of 3.9% year over year, while wages have grown just 30%. That's creating the perfect storm for potential housing market instability. If you're wondering whether we're heading toward another housing crash, you're not alone. Today, we're breaking down the 5 critical warning signs that suggest the housing market could be on shaky ground. Welcome back to the channel. I'm here to give you the straight facts about what's happening in the housing market right now. Whether you're a homeowner worried about your property value, a potential buyer waiting for the right time to purchase, or an investor looking to make smart decisions, understanding these warning signs is crucial for your financial future. The housing market doesn't crash overnight. It gives us signals, patterns, and red flags that savvy observers can spot before things get out of hand. Today we're going to examine 5 key indicators that suggest we might be heading toward a significant market correction. Remember, knowledge is power when it comes to real estate investing and home ownership. By the end of this video, you'll know exactly what to watch for and how to protect yourself financially. Let's be honest about where we stand. The housing market is facing unprecedented challenges that mirror some of the conditions we saw before previous market crashes. We're dealing with a perfect storm of factors: mortgage rates that have climbed dramatically, home prices that have outpaced wage growth, and an affordability crisis that's locking millions of Americans out of home ownership. The 2025 US housing market is flashing warning signs reminiscent of 2008: rising household debt burdens, persistent inflation, and home prices that are outpacing incomes. While the lending standards are stricter today than they were before the 2008 crash, that doesn't mean we're immune to market corrections. The central challenge is this: when housing becomes unaffordable for the majority of the population, demand eventually collapses. And when demand collapses while supply remains high or increases, prices have nowhere to go but down. This isn't fear-mongering, it's basic economics. What makes this situation particularly concerning is that, unlike previous market cycles, we're dealing with multiple pressures simultaneously: inflation, high interest rates, student debt burdens, and a generation of potential home buyers who've been priced out of the market entirely. The first and most obvious warning sign is the severe affordability crisis we're experiencing right now. Home prices have risen 52% since 2019, while wages have grown just 30%. Combine that with mortgage rates hovering near 7%, and you get a market that's functionally closed to a growing number of Americans. Let me put this in perspective with a simple example. Imagine you're a teacher making $50,000 per year. 5 years ago, you might have been able to afford a modest home in your area. Today, that same home costs 50% more, but your salary has only increased by 30%. Meanwhile, your monthly mortgage payment has nearly doubled because of higher interest rates. This isn't sustainable. When the majority of working families can't afford to buy homes, the market becomes dependent on a shrinking pool of buyers. First-time buyers, FTBs, are facing the toughest conditions in decades. Last year, just 1.1 million FTB purchases were recorded, representing a significant decline from historical norms. The mathematics are simple. If median home prices are $400,000 and median household income is $70,000, families need to spend nearly 6 times their annual income on housing. Historically, the healthy ratio is closer to 3 to 4 times annual income. What's particularly concerning is that we think rising incomes can break the US housing market's logjam nationally in about 3.5 years. But for large cities, we see an average of over 5 years. This means the affordability crisis isn't a temporary blip. It's a structural problem that could persist for years. When housing becomes this unaffordable, one of 2 things happens. Either wages need to rise dramatically and quickly, or home prices need to fall significantly. Since wage growth typically happens gradually, the more likely scenario is a price correction. The second warning sign is the combination of increasing inventory and stagnant buyer demand. 3 critical indicators: stagnating price growth, soaring inventory, and unsustainable mortgage rates are converging to create a perfect storm of risk. Here's what's happening. Sellers are still pricing their homes based on the peak market conditions of recent years, but buyers can't afford those prices with current mortgage rates. This creates a standoff where homes sit on the market longer, inventory builds up, and sellers eventually have to reduce prices to attract buyers. Think of it like a retail store that's overpriced. At first, the store might maintain high prices hoping someone will pay them. But as inventory piles up and sales slow down, they're forced to have sales and clearances to move products. The housing market works similarly, but the cycles are longer. From an affordability perspective, we think 2025 will look a lot like 2024, with mortgage rates above 6%, home price growth easing from recent highs but staying positive, and supply remaining below pre-pandemic levels, according to recent analysis. However, this stability is fragile. The danger comes when this inventory buildup reaches a tipping point. When sellers realize they need to compete more aggressively on price, it can trigger a cascade effect. One seller drops their price by 10%, forcing neighboring sellers to follow suit, which leads to more price reductions across the entire market. We're already seeing early signs of this in certain markets. Days on market are increasing, price reductions are becoming more common, and buyer activity is sluggish despite lower mortgage rates in some areas. The lock-in effect is also creating artificial scarcity. Many homeowners are reluctant to sell because they have mortgage rates below 4% and don't want to give up those favorable terms. This creates a false sense of supply shortage, but it also means that when these homeowners do decide to sell, it could flood the market with inventory. The third warning sign is the increasing financial stress on American households. Consumer debt levels have reached concerning heights, and when combined with high housing costs, it creates a vulnerable situation for many families. Let's talk about the debt-to-income ratios. The average American household is carrying more debt relative to their income than they were before the 2008 financial crisis. This includes credit card debt, student loans, auto loans, and of course, mortgages. When households are stretched thin financially, they become more vulnerable to economic shocks. Here's a real-world example. Imagine a family spending 35% of their income on housing, 15% on other debt payments, and dealing with inflation that's eating into their purchasing power. If one spouse loses their job or faces a medical emergency, they quickly find themselves unable to make mortgage payments. The concerning trend is that many families are using credit cards and personal loans to bridge the gap between their income and their expenses. This creates a house of cards effect where any disruption to income can trigger a cascade of financial problems. What makes this particularly dangerous for the housing market is that financially stressed households are often forced to sell their homes quickly, sometimes at below-market prices. When this happens on a large scale, it can depress home values across entire neighborhoods. Additionally, lenders are starting to tighten credit standards in response to economic uncertainty. This means fewer people qualify for mortgages, which reduces the pool of potential buyers and puts downward pressure on home prices. The student debt crisis is also playing a role. Many potential first-time home buyers are carrying substantial student loan debt, which affects their debt-to-income ratios and makes it harder to qualify for mortgages. This demographic shift means fewer people entering the housing market at the bottom end, which traditionally drives demand throughout the entire market. The fourth warning sign involves broader economic indicators that suggest we might be heading toward a recession. Housing markets are closely tied to overall economic health, and when the economy weakens, real estate typically follows. Let's examine some key economic indicators. Unemployment rates, while still relatively low, have been showing signs of increase in certain sectors. Unemployment and underemployment negatively impact the housing market by reducing the purchasing power of potential home buyers. Inflation remains a persistent concern, even though it's cooled from its peak levels. High inflation erodes purchasing power and forces central banks to maintain higher interest rates, which directly impacts mortgage rates and housing affordability. Corporate earnings have been mixed, with some companies reporting slower growth or declining profits. This often leads to layoffs and reduced hiring, which affects consumer confidence and spending power. When people are worried about job security, they're less likely to make major purchases like homes. The yield curve has also been inverted at various points, which historically has been a reliable predictor of recessions. When this happens, it signals that investors are worried about future economic growth and are demanding higher returns for longer-term investments. Consumer confidence surveys have shown increased pessimism about the economy's direction. When people feel uncertain about the future, they tend to delay major financial decisions, including home purchases. This reduction in demand can trigger price declines in real estate markets. Business investment has also been declining in some sectors, which typically leads to reduced job growth and lower wage increases. Without strong employment growth and rising wages, the housing market loses its foundation of qualified buyers. The combination of these factors creates a scenario where economic growth slows, unemployment rises, and consumer spending decreases. This trifecta typically leads to housing market corrections as demand evaporates and sellers are forced to reduce prices to attract the shrinking pool of qualified buyers. Now we come to the most alarming sign, what I call the interest rate trap. This is the situation that could serve as the tipping point for the entire housing market. The higher for longer interest rate backdrop is here to stay, with mortgage rates expected to ease only slightly to 6.7% by the year end. Here's why this is so dangerous. We're caught in a situation where interest rates are high enough to kill affordability, but not high enough to crash the market quickly. This creates a slow-motion disaster. Unlike the rapid crash of 2008, we're looking at a prolonged period of declining activity, increasing inventory, and gradual price erosion. This is actually more dangerous than a quick crash because it creates uncertainty and prevents the market from finding its natural bottom. The trap works like this. High mortgage rates prevent people from buying homes, which reduces demand. But many homeowners are locked into low-rate mortgages and don't want to sell because they'd have to buy their next home at much higher rates. This creates artificial scarcity that keeps prices elevated despite weak demand. Eventually, this artificial support breaks down. Economic pressures force people to sell regardless of the interest rate environment. Job losses, divorces, relocations, and financial stress don't stop because of mortgage rates. When these forced sales increase, they flood the market with inventory, just as buyer demand is weakest. The result is a market correction that happens gradually, then suddenly. Prices remain elevated for months or even years, giving people false confidence, and then drop rapidly when the artificial supports give way. This is the most dangerous scenario because it catches people off guard. They see stable prices and assume the market is healthy, but underneath the foundation is crumbling. When the correction finally comes, it's swift and severe. Let's recap the 5 warning signs we've discussed today. First, the extreme affordability crisis that's pricing out the majority of potential home buyers. When working families can't afford homes, the market becomes unsustainable. Second, the inventory surge combined with stagnant demand. This creates a buildup of unsold homes that eventually forces price competition among sellers. Third, rising household debt and financial stress. Over-leveraged families become vulnerable to economic shocks and may be forced to sell their homes quickly. Fourth, broader economic indicators pointing toward recession. When the economy weakens, unemployment rises and consumer confidence falls, reducing demand for housing. And fifth, the interest rate trap that's creating artificial market conditions that could collapse suddenly when economic pressures force more people to sell. These warning signs don't guarantee a housing market crash, but they do suggest that the current market conditions are unsustainable. Smart homeowners and investors should be preparing for potential market corrections by building emergency funds, avoiding over-leveraging, and being cautious about timing major real estate transactions. Remember, every market cycle is different, and timing market corrections is extremely difficult. The key is to stay informed, be prepared, and make decisions based on your individual financial situation rather than trying to time the market perfectly. What do you think about these warning signs? Are you seeing any of these indicators in your local market? Drop a comment below and share your observations. I read every comment and love hearing from viewers about what they're experiencing in their areas. If you found this analysis helpful, make sure to like this video and subscribe to the channel for more in-depth financial content. Hit that notification bell so you don't miss our upcoming videos on protecting your wealth during market uncertainty. And with every housing crash, some people become wealthy. Check out this other video, Why a Housing Crash Could Make You Rich. You'll find the link in the description below and info card on top. Remember, knowledge is your best defense against market volatility. Stay informed, stay prepared, and I'll see you in the next video.